The year is now 2026. The stock market is near all-time highs. AI is everywhere around us. Unemployment remains at record lows. Inflation is under control. And yet, something feels off. You can see it in the way analysts talk, in the way CEOs hedge their optimism, in the way investors cheer good news a little too hard, like they're trying to convince themselves. Because when everything looks fine at the surface, but everyone feels uneasy underneath, that's usually when the system is stretched the thinnest. We have definitely seen this before. Not the same headlines, not the same companies, but the same pattern. And 2026 is starting to rhyme. Let's start with the obvious. 7 companies now make up a massive portion of the entire US stock market. Trillions of dollars in value concentrated in a handful of names. AI leaders, chip makers, cloud giants, companies that have become not just businesses, but infrastructure. Their profits are real. Their technology is transformative. Their dominance is undeniable. But concentration has a strange psychological effect on markets. When a small group of companies carry the entire index higher, it feels like strength. The charts look powerful. The headlines celebrate resilience. But underneath, breadth quietly shrinks. Fewer stocks are actually participating. Fewer sectors are driving growth. The market becomes less like a rising tide, and more like a few heavy pillars holding up a fragile roof. And if one pillar cracks, the whole structure shifts. Now layer on top of that the interest rate story. Just a few years ago, central banks were fighting inflation with the fastest rate hikes in decades. Borrowing costs surged. Mortgages doubled in price almost overnight. Corporate debt rolled over at significantly higher rates. Governments added trillions to their interest expenses. Then came the pivot, rate cuts. Not aggressive ones, not emergency ones, but enough to calm investors, enough to spark rallies, enough to reignite risk appetite. The markets absolutely love rate cuts. But here's the uncomfortable truth. Central banks don't cut rates because everything is amazing. They cut because something is weakening. Sometimes it's subtle. Slower hiring, softer manufacturing, quiet stress in credit markets, regional banks wobbling, commercial real estate vacancies creeping higher. In 2026, rate cuts feel like relief. But relief from what? That is the ultimate question. Because if the economy were truly accelerating, rates would stay higher. Strong growth doesn't need life support. So we're in this strange middle ground. Growth is okay, inflation is manageable, rates are coming down, stocks are strong. Everything is just stable enough to keep the party going. And that's what makes it fragile. Now let's talk about AI. The AI boom has become the defining investment theme of the decade. Data centers are expanding at historic speed. Energy demand is surging. Companies are spending billions on chips, servers, software, integration. Capital expenditure is absolutely exploding. And that is a very important point. Because when companies ramp up spending this aggressively, they're making a bet, a massive one. They're assuming future demand will justify today's investment. That's how bubbles quietly form, not through hype alone, but through overcommitment. In the late 1990s, companies built fiber optic networks across continents. The internet was real, the future was real. But capacity was built far beyond immediate demand. When expectations cooled, prices collapsed. Today, data centers are the new fiber cables. GPUs are the new routers. Everyone assumes AI usage will scale infinitely. That productivity gains will justify any valuation. That this time is different because the technology is genuinely revolutionary. And it might be, but revolutions don't exempt you from math. If every major tech firm is investing at the same time, margins compress. Competition increases, pricing power erodes, the winners survive, the rest bleed quietly. Yet markets price all of them like winners. That's not skepticism, that's faith. Meanwhile, the consumer, the actual engine of most economies, is more stretched than the headlines suggest. Credit card balances sit near record highs. Auto loans have grown heavier. Student loan payments resumed after long pauses. Savings accumulated during stimulus years have largely been spent. Wage growth has cooled from its post-pandemic surge. Housing affordability remains strained. Insurance costs are rising. Energy prices fluctuate unpredictably. Nothing is collapsing, but nothing feels easy. The system is operating with thinner cushions, and thin cushions mean less room for error. Then there's government debt. Globally, debt to GDP ratios are hovering near historic highs. In the United States alone, total federal debt has crossed levels that would have seemed unthinkable 20 years ago. Would you like me to continue with the next part of the script? For years, low interest rates made that manageable. Debt was cheap. Servicing costs were tolerable. But higher rates changed the equation. Even if rates fall slightly in 2026, they are unlikely to return to the ultra-low levels of the 2010s, which means governments are rolling over old debt at higher costs. Interest payments become one of the largest budget items. When that happens, policy flexibility shrinks. In the next downturn, stimulus becomes harder. Bailouts become politically toxic. Fiscal space narrows. So we have concentrated markets, massive AI investment, consumers stretched, governments indebted, central banks easing cautiously. Individually, none of these are catastrophic. Together, they form a system highly dependent on continued optimism. And optimism is a fragile resource. There's also the global angle. Geopolitical tensions haven't disappeared. Supply chains have been reshuffled but not fully stabilized. Trade relationships are more politicized. Elections across major economies inject uncertainty into fiscal and regulatory decisions. In a globally interconnected financial system, shocks travel fast. In the year 2008, it was subprime mortgages. In the year 2020, it was a global pandemic. In the year 2022, it was record inflation. The trigger is always different. The vulnerability is always structural. Right now, the vulnerability isn't obvious excess in one small corner. It's systemic interdependence. Markets depend on AI growth. AI growth depends on capital spending. Capital spending depends on cheap financing. Cheap financing depends on central banks. Central banks depend on stable inflation. Stable inflation depends on supply chains, energy markets, and geopolitical calm. It is all part of one giant chain, and chains don't need every link to break, just one. There's also something psychological happening in 2026. Investors have been conditioned. Every dip in the past decade has been bought. Every crisis has been followed by stimulus. Every shock has been met with liquidity. So when volatility appears, the instinct is immediate. Buy. And for a long time, that worked. But strategies that work repeatedly create complacency, and complacency builds leverage. More margin debt, more options speculation, more retail participation in high beta names, more private equity funded by cheap loans, more venture capital chasing the next AI unicorn. It feels sophisticated, it feels innovative. But underneath, it's the same human pattern. Fear fades, risk expands. There is also another great irony. This is the great irony of certainty. Productivity gains from AI are expected to boost corporate profits dramatically. Yet if productivity rises too fast, labor displacement increases. If labor displacement increases, wage pressure weakens. If wages weaken, consumer spending slows. The very technology expected to drive growth could, in the short term, suppress demand. And markets rarely price second-order effects until they happen. Now zoom out even further. Demographics in many developed economies are aging. Labor force growth is slowing. Pension systems face pressure. Healthcare costs rise. Growth potential structurally declines over time in aging societies unless offset by productivity miracles. Maybe AI delivers that miracle, but miracles, as we know, take time. Markets move daily, so what exactly feels off about 2026? It's not that the numbers are terrible. It's that they're perfectly balanced on assumptions. AI demand, inflation, rate cuts, debt, and calm. Each assumption individually seems reasonable. Together, they create a narrow path, a very narrow path indeed. History shows that markets struggle most not when things are obviously bad, but when they're priced for perfection, because perfection leaves no margin for surprise. In 1999, the internet was real. In 2006, housing demand was real. In 2021, digital adoption was real. Reality doesn't prevent bubbles. It often fuels them. And here's the subtle warning sign in 2026. Narratives feel too unified. When everyone agrees on the future, that AI will dominate, that certain companies are untouchable, that rate cuts guarantee upside, dissent fades, valuations stretch, risk models assume stability, analysts raise targets instead of questioning premises. The market becomes less about price discovery and more about narrative reinforcement. That doesn't mean collapse is imminent. It means fragility is rising. Perception becomes reality until it doesn't. Imagine for a moment a spinning wheel. Each segment represents a possible outcome. AI continues booming. Mild recession. Rate cuts spark another surge. A major tech company stumbles. Energy shock. Geopolitical escalation. Nothing happens at all. Right now, investors are betting heavily on just one or two slices of that wheel. But the wheel, it keeps on spinning. The uncomfortable truth about financial systems is that they rarely fail because of what everyone is watching. They fail because of what no one thinks matters. In 2026, everyone is watching AI valuations. Everyone is watching central banks. But fewer people are watching liquidity in smaller banks. or stress in commercial real estate refinancing, or the compounding effect of government interest payments, or the long-term sustainability of consumer credit growth. Those aren't exciting topics. They're structural ones. And structural weaknesses don't trend on social media. Until they do. There's also timing. Economic cycles don't die of old age, but expansions built on stimulus eventually encounter constraints. We're more than a decade removed from the last traditional recession. We've had shocks, yes, but we haven't had a prolonged credit contraction cycle since 2008. Credit cycles matter because modern economies are credit-driven. When credit expands, growth accelerates. When credit tightens, growth slows. This is the natural cycle of the system. If lenders become cautious, even slightly, the ripple effects compound quickly. In 2026, lending standards are not collapsing, but they are cautious. Capital is available, but selective. Risk premiums are low, but rising at the edges. It's subtle. Subtle is how shifts begin. So maybe nothing dramatic happens. Maybe AI revenue justifies valuations. Maybe rate cuts are perfectly calibrated. Maybe debt rolls smoothly. Maybe productivity surges and lifts all boats. That's possible. But if there's one lesson markets teach repeatedly, it's this. Stability breeds instability. The longer volatility stays suppressed, the more risk accumulates beneath the surface. And when adjustment comes, it feels sudden, even though the ingredients were visible all along. So when people say, something feels off about 2026, they're not pointing to one catastrophic statistic. They're sensing imbalance. They're sensing that markets are strong, but narrow. That growth is positive, but dependent. That optimism is high, but conditional. It's the feeling of standing on ice that hasn't cracked, but sounds hollow when you step. The question isn't whether 2026 collapses. The real question is this. If even one of the core assumptions breaks, AI demand slows, inflation reaccelerates, debt markets tighten, geopolitical tension spikes, does the system absorb it calmly? Or does the concentration, leverage, and optimism amplify it? Because the scariest market environments aren't the ones where everyone is afraid. They're the ones where everyone is comfortable. So maybe nothing dramatic happens this year. Maybe 2026 ends with new highs and celebratory headlines. Or maybe, years from now, we'll look back and realize this was the point where the system was stretched just a little too tight, and no one wanted to say it out loud. The wheel is still spinning, the bets are placed. The question is simple. When it stops, which slice does it land on?